Let's see, I think I was using the wrong microphone there. Hopefully you can hear me okay, and what we're going to do is do Chapter 7. Actually, I'm a few days late with Chapter 7 video, and so I have extended the homework till this Friday. It was originally due, I think, tonight. Just, I don't know, lots of things going on, the snow, that sort of stuff. Anyway, the good news is that Chapter 7 and Chapter 8 are fairly straightforward and not that consequential. So I'm going to make Chapter 7 due this Friday, and then we'll keep Chapter 8 on the normal time frame, but I'm going to actually go through some of the homework to sort of shorten the time, because this chapter, especially Chapter 7, there's not a whole lot of content, and so it's best just to kind of show you by working through some of the homework. So let's take a look at the Chapter 7 ideas. The Chapter 7 idea is talking about accounting information systems, or accounting systems. Let me move this microphone here a little bit. Accounting information systems. Basically, it's the software system. And so you've probably bought or seen people use QuickBooks or that sort of thing. If you use TurboTax, that's the same people who make QuickBooks. But there are ways to keep track of a company's, all this debits and credits. Now, a big company would have a software package maybe called an enterprise resource planning system. An ERP system, and those can go for a lot of money, and they track a lot of things. I remember when I was working with Nike back in the early 2000s, and they had spent something like $400 million on an ERP, and it took over a year to implement, and at the end of it, it was completely botched. I think they had to completely remove it or start over because it didn't go very well. So these are very expensive systems, and if you get them wrong, it doesn't look very good for everyone involved. Anyway, we're not going to be looking at an enterprise resource planning system. We're just going to be looking at basically two aspects of what a computer system might do as far as automating the type of work that we've been doing. So the two things we're going to look at, and then we look in the homework, is that we have the first one is called a subsidiary ledger. So remember that the financial statements are for external users. It's for investors or the government or for your creditors. And remember, all the financial statements, they're summaries. They're not every little piece of detail. They're not every little transaction you've ever done. Now, you do record all those transactions, but you summarize them and pull them together into sort of big accounts. Well, sometimes you still need some of that detail to run your business, and that's what a subsidiary ledger is. For example, in the financial statements, you might have accounts receivable, which is all of the people who owe you money, or all the money that you're owed, right? So that's in what we call the general ledger, and that would go into the financial statements. But wouldn't you want to know by individual customers how much each individual customer owed you? So you'd have these subsidiary accounts, and they'd be divided up into customer A, customer B, etc., etc. But all of these subsidiary ledgers would have to add up and equal the AR account, and we call this the control account. This is the account that actually goes into the financial statements. So no matter how many of these subledgers that we have, they would still add up to be the total amount for the control account. But you notice that this is based upon accounts. We also have a different type of set of entries or specialty things that we can use with software, and they're called special journals. So there are certain types of transactions that kind of go together and that we want to track together. And for the purposes of this chapter, we're actually only going to look at 4 or 4 plus 1. And those are going to be all of the journal entries that kind of go together as far as making a sale. And what are they? Well, that's going to be like AR. It's going to be revenue. Remember, we also have to take into account the inventory, right? And the COGS, so that would be inventory and COGS as well. So those would be four accounts that you would have to work through, but they all get covered when we do a sale. So we have a sales journal, and we'd also have a purchase journal when we're purchasing things. And by sort of default, when we say sales or purchase, we're actually saying sales or purchases that are on account, meaning that they're AR or they're AP. So here this would be AR, this would include an AP. And then we would have separately things dealing with cash receipts. This would be people who are paying us cash for sales, or when we're collecting AR, and we would have cash payments. So you can see there are two pairs here, sales and purchases, cash receipts, cash payments. And then if you had an unusual journal entry, and in the case of this, what we call unusual is like a sales return or a sales discount. Well, we wouldn't necessarily put them in these per se. Perhaps those would go directly to a general. We would bypass one of these special journals and just put it directly into the general ledger. So it still gets recorded. It's just not one of the common transactions that gets covered in the special journal, in one of the special journals, or when in one of the subsidiary accounts. So essentially, there is some more reading in the chapter, but that's, believe it or not, that's what the majority of the chapter is about. Now, they do go through and they do talk a lot about these individual accounts, these individual special journals, but what I'm going to do is I'm just going to kind of explain it as we go through a couple of homework items. So let's take a look. I'm not going to go through every homework and I'm not every question, but I'll go through probably 4 of them, and I'll go through parts of them. So this first one here, this is just a couple, this chapter is kind of definition heavy, so I have a question here that's kind of definition heavy. So basically it just says here's 5 definitions. What is the word they're trying to describe? So like enables the tracking of all transactions. That's an audit trail. C, identifies suspicious transactions or likely mistakes such as wrong account. That's going to be internal control. So these are the sort of things that you can go through and maybe just look at the end of each chapter. There's a glossary that kind of tells these, or you can kind of just figure it out by reading them and figuring out what they go to. But here are 2 of them, kind of 2 that I want to make sure you do know, i.e. might be on the test. So go ahead and fill those out. Let's take a look at the next one. Here are a couple of typical transactions. So what they're basically saying is, remember, we're looking at 5 different types, 4 special journals and then the general ledger. That's why I say 4 plus 1. And what they're trying to say is, can you go through all of these transactions and identify which one is which? So I'm not going to do all of them, but I'll do a couple of them. Payment of creditors on account. Well, you see the word account, and so you might think it's like a purchase or a sale because that's on account. But remember, this is one of those ones that's a little tricky, and that's why I'm kind of walking through it, is when you see the word payment, when you see payment, or you see the word collection, that's talking about cash. So this is, we previously purchased something on account, but now we're paying them. And what are we paying them with? Well, we're paying them with cash. So this is a cash, this goes on the cash payments journal. Let's take a look at return of merchandise sold for credit. Well, there's going to be a couple of these that are just sort of don't fit on any of the 4. They're not a cash payment. They're not a cash receipt. They're not a sale on account. They're not a purchase on account. This is one of those. So this kind of goes on the general journal. And what I'm going to do is I'm going to show at least one of each of these different types. Let's look at 5 and 6. Sale of merchandise on account and sale of merchandise for cash. So you notice that these 2 are exactly the same, except one says on account and one says for cash. So this one, well, we said that anything that is something on account, a sale on account, we would put in the sales journal. And this one for cash, anything that would be a cash, this is going to be sale of merchandise. So we're going to be receiving cash. So this would be a cash receipts journal. Similarly, let's look at 12 and 13. Purchase of office supplies for cash. Well, we're purchasing something and using cash, so that's a cash payment. And then purchase merchandise on accounts. That's a purchase journal. So I think I've actually got 2 of the cash payments, but you can see I've got at least one of each of these different types. So using that thinking, anything that you see payment or collection that has to do with cash, like here's a payment. Anything that's talking about a purchase or sale, that's probably going to go in one of these 2. A purchase or a sale could be either a sale purchase on account or it could be a cash one. So just make sure you get those correct. Let's see. Number 3, I think I'm going to skip over. I think I'm going to go to 4. My internet connection isn't so great here. Hopefully I'm going to get that fixed here soon. Sometimes it just glitches and hangs. And of course, wonderful us. So here, let me pause it while it's doing its thing. Okay, we're back. Let's take a look. So here, we've got 4 parts. What is the balance of account? The control account, which means that, remember, the control account is the main account. Part of this question, it has to be complete, or so we can't see what's going on. So what is the balance? What is the balance in the accounting control account? Let's see. So part of this is, you notice that we still have we have a sales journal, purchase journal, cash receipts, and cash payments. And we have to know kind of what they mean. And they give a little definition here: total sales, total purchases, accounts receivable column, accounts payable. Well, so the first one is asking here is, what is the accounts receivable control account? Well, what do we start off in our accounts receivable control account? Has a debit balance of $290. So we have $290. And if you want to think about, here's the AR account, right? So we've got $290K here. What things increase AR and what things decrease AR? Well, the things that increase AR are things when we make a sale on account. We debit AR, we debit AR, and we credit revenue. And what things reduce AR? When we collect the cash, when those customers that owe us the cash, we collect the cash and we reduce the AR. So 2 of these 4 journals are going to have something to do with this. So total sales, well, that's going to increase it. These are new credit sales or new sales on accounts. And then the cash receipts journal, this is the amount of cash. This is the second thing. We collect the cash, but consequently we also reduce the AR. So that's going to be on this side. So it's a simple a simple math problem. It's 290 plus 155 minus 125 would be the answer there. Oh, and because they want me to do it, so this is $570. Does that look right? And of course, I just added all 3 together. I even just I just made my own mistake that I tell people not to do. This is minus, right? So what are we doing? We're actually only adding 30, right? 155 minus 125, that's only addition of 30. So 290 plus 125 minus 125 is going to be 320. So let me put that number in. See if that's right. There. The next one is, what is the balance in the accounts payable account? And I think your numbers are going to be different. Well, the accounts payable account is just going to be sort of the opposite. Why don't I say it's going to follow the same way, right? What increases accounts payable? When we make purchases. So it says here that the beginning balance is $75,000. What increases it? Purchases. What decreases it? When we pay our vendors. So that's the cash payments journal. So what do we have? We have 75 plus 51 minus 40, or an increase of 11. So that looks like it's going to be 86. So I put 86,000 here. C. To what account is the column total of 155 going to? 155. Well, we kind of talked about that. Here we said the 155 is a debit to AR. And if I were to look at this, it's a debit to AR and a credit to revenue, right? When we look at the actual journal entry. So it is a credit to sales. It's this first one here. Credit sales revenue and debit AR, right? And the last one, to what account is the AR column of 125 being posted? 125, that's the cash receipts. What's going in the cash receipts journal? And therefore, it is going to be, let's see which one of these. So what we're looking at is, we're looking at this second one. It's a debit to cash and a credit to AR. So it's not a debit to cash in the general ledger. Oh, I guess I see what they're saying. It's already in the cash journal. It's in the cash receipts journal. So in the cash receipts journal, all of those are debits to cash. So what we're saying is it's debit to cash and it's a credit to accounts receivable. Okay, there we go. Let's see. I'm going to take a look at a couple more and then we'll be done. In fact, believe it or not, this chapter only really requires us to have one video. So that's why I think it's not going to be too much trouble. Okay, so here we go. Let's take a look at this problem. And let's see, 5. Crane Company has a balance in its AR control account, so that's the main account of 11,400. Subset. Okay, so the previous one was about special journals. This one's about subsidiary ledger accounts. So this is the one where we say AR is a total, but within AR we're going to look at individual customers. So we've got 3 here: Bixler, Cuddier, and Freeze. And what's the first question? What is January balance for the Freeze account? Well, this one's pretty straightforward. So if the total AR is 11,400 and we have, let's see, Bixler. So 11,400 is made up of these 3 accounts: 3,900, Cuddier, 2,100. And you notice here they kind of sneakily do not tell us what Freeze is. That's the unknown. So basically, 11,000. These 3 together should equal 11,400, or we could do 11,400 minus these 2 to get to the answer. Minus 3,900 minus 2,100 is what is in Freeze. So this is going to be 6. So 5,400. It looks like it's going to be what's the amount here. Okay, so that's correct. What is the January balance in the control account? January. Okay, so I may not go ahead and do all of this. Oh, well, shoot. I hate when they don't tell you what the other parts of the question, and therefore I can't kind of just tell you what to do for those. So what we're going to do is, well, remember AR, the total AR starts out at 11,400. Then we have all of these credit sales, so all of these are going to increase AR. The collections are all going to reduce, and the returns are also going to reduce. So what we're going to do is 11,400 plus all of these, plus 9,000 plus 6,500 plus 8,100, and then we're going to reduce all the collection, minus 7,700 minus 2,500 minus 8,700, and then we're going to reduce by the returns. And so that should be, that's taking the total balance plus all the individual companies' additions minus all the collections minus the returns. So let me go ahead and do that here. So going through and doing 11,400 plus all of the credit sales minus all the collections minus the return, we come to a balance in the control account of 13,400. Okay, compute the balances in the sub-accounts at the end of each month. Okay, so this is going to be to where if Bixler started off at 3,900, we're going to add 9,000 for their sales minus 7,700 for their collections. So that is going to be I'm going to say 5,200 for that one. Well, let me just, maybe I'll make sure calculate it. 3,900 plus 9,000 minus 7,700 equals 5,200. The next one is going to be, and the 3,900 I got from the text at the top. Cudyear had balance of 2,100 plus 6,500 minus 2,500 minus 2,700. So they're going to be 2,100 plus 65 minus 2,500 minus 2,700 equals a balance of, so this is the balance in the first one, this is the balance in the second one. And the third one, remember we had to calculate the balance, beginning balance, which was here, which was part A. So 5,400 plus 8,100 minus 8,700. So that's going to be minus 600. So what is that going to be? 4,800. Let me just double check. Yeah, 4,800. So this question looked at the total control account. This one's looking at the individual subsidiary accounts. So 5,200, 3,400, and 4,800. We could also double check by adding these together should come to the total account, right? So if I add 4,800 plus 3,400 plus 5,200, that should come out to the same amount as the total account. So the three sub-accounts should add up to the total account, and in fact it does. The last one is, which transaction would not be recorded in a special journal? Well, obviously, all these sales and collections, those are all, the cash journals and the sales journals, purchase journal. Returns is the one unusual one, so that one go into the sales return would go into the go straight to the general ledger. We don't have a special journal or a sub ledger for that. And that one's correct too. Let's go to the last one. And I'm not going to do the last one, but I'm just going to show you a pertinent thing about the last one. So here's question number 6. And we've got a sales journal, which has 2 entries. And then it doesn't show it, but part B is a purchase journal that has 2 entries. So what I'm going to do is, in other words, there are 4 entries that they're looking for, but they give us 6 entries. So let me help you identify which of the 2 entries are not used. So when we go through and we talk about them, remember we're either looking for something that is a purchase or a sale on account, and that it's for a regular type of purchase like merchandise or sale to a customer. So September 2nd, sold merchandise on account. Well, that looks correct. That would go into one of the journals. September 10th, purchase merchandise on account. Again, that looks, one would be a sales journal, one would be a purchase journal. September 12th would be an unusual one because it's not dealing with our normal customers. It's talking about purchasing office equipment. So September 12th would not go on the normal sales and purchase journal, wouldn't go in the purchase journal because it's not a purchase of merchandise. It's not dealing with our normal things that we buy and sell. This would be like a one-time buy. September 21st, sold merchandise on account. That looks correct. September 25th, purchased merchandise on account. So you notice I'm looking for purchased merchandise or sold merchandise on account. And that those would go into the sales journal or the purchase journal. When we're talking about, long-term assets like September 12th, purchase office equipment, that doesn't go into the purchase or sales journal. And then the other one that wouldn't go is this one, September 27th, because it says sold merchandise. Well, we're okay with sold merchandise, but you notice here it was for cash. It wasn't on account. So that wouldn't go into the sales journal because that would go actually into the cash receipts journal, and they're not going to ask us about the cash receipts journal. So what you need to do for these 2 is just to put the 2 sold merchandise in the sales journal and the 2 purchase merchandise in the purchase journal, which would be B. Okay. We only have one. That's all that I'm going to show for this chapter. I've gone through most of the homework, showed you how to get done. It'll be due this Friday. And the additional thing that even though this ran a little bit longer, we're only going to have one video for chapter 7. And I think I can get away with one video for chapter 8. And I'll upload that tomorrow on Monday. Okay, if you have any questions, let me know. Hope everyone's doing well.